precious metals. There was maybe a dead cat bounce earlier this week, but silver in particular getting sold hard again today. The BDCs that we've been following, private credit funds, they continue to get sold, an accelerating downside in all those names that we keep following for reasons that will become apparent as we get to the end of this. What else do we got? We got safety bids. Bond yields are falling. The 2-year Treasury down, 10-year Treasury down. The yield curve still a little bit steepening. And finally, cryptocurrencies, risk assets. Cryptocurrency, Bitcoin in particular, is a proxy for marginal risk taking in financial markets related to tech and AI and other things as well, plus some comments from Michael Saylor that just had, even I think proponents of Bitcoin and those who are following Michael Saylor are shaking their head after this one. It's with accelerating downturn in Bitcoin, his comments just aren't helping. But the point here is that we've got multi-asset meltdown all across some of the more risky momentum parts of the marketplace, and all of it related to the same fundamental problem, which is that the U.S. economy and the global economy in particular, all of it together, is not doing what it's supposed to do. This is supposed to be rebound 2026 or strong economy 2026. Instead, we got a whole range of labor market data today that suggests the exact opposite, which is why you're getting more momentum meltdowns all across these financial markets. So let's get into all of our stuff. We got a lot to go over today. A lot of stuff is happening. It's the old adage, may you live in interesting times. Well, the interesting times are exceptionally interesting at the moment. And it doesn't really matter where you're looking. Even the stock market's getting involved in it too. But just a whole bunch of stuff going on, like I said. Silver and precious metal, all of it, just lots of stuff going. So we're going to start with credit and BDCs because I think that's the most important one. Again, we've been following the cockroaches, but it's not really about the cockroaches. The cockroaches just got our attention, grabbed our attention, and even mainstream attention for a while. And like I said a couple of days ago when we specifically focused on BDCs, Blue Owl, the name that keeps coming up. The cockroaches just started everything, and they didn't go away. I mean, the cockroaches seem like the names that we had, First Brands, Tricolor, Renovo. Seems like everything went quiet, but underneath the mainstream surface, did not get quiet. In fact, we continue to see more downside emerge all across the space. Risk financials, I mean, the NASDAQ is down, the stock market is down, but really talking about cryptocurrency right there. Metals prices, people were hoping that silver and gold would hang in there. Gold is actually holding up relatively well, which is not a surprise. We're given everything else melting down. There's a little bit of haven bid, while silver is unfortunately undergoing drastic liquidations. Safety, talking here about U.S. Treasuries, but also want to go cover tips and what's going on in the tips curve, just to put a final touch on everything, bring everything together on the macroeconomic umbrella, the fundamentals of everything, whether it be credit, risk assets, or precious metals, what's really happening from a comprehensive perspective. And finally, why is all this taking place today? I mean, we knew about this before, but today more confirmation all across the board as far as labor market deterioration, at the very least, labor market weakness when it was supposed to be shifting in the other direction. Even though we have to wait another 6 days to get the payroll report for the month of January. Today we saw JOLTS, Challenger Gray, and Christmas. A whole bunch of really ugly numbers that at the very least, like I said, suggest the economy is not moving in the right direction. So we're going to start out with credit markets, the BDCs, private credit, because the sell-off is getting to be, well, here, I'll show you in just a second here when it comes up. Sell-off in private credit. We'll start with Blue Owl, and Blue Owl's their BDC. Remember, BDCs are business development companies or business development corporations, which are nothing more than the vehicles that these fund companies that allows them to have some of their funds be publicly traded. The reason I put the reflation and interest rates up there with the movement in the chart is that the common excuse has been that lower rates are bad for BDCs because a lot of these loans that go into private credit portfolios are variable rate, and therefore as interest rates go down, not because of the Fed, because of the market, remember the Fed always follows the market, but as interest rates go down, that's supposed to be bad for business development companies because their portfolios are going to have to expire, the loans expire and they get refunded at lower interest rates. However, it's pretty clear that's not what's going on here. There is some interest rate story. In many ways, it's the backwards one from here in the mainstream. Like in 2022, interest rates were going up, yet BDCs were going down from some macroeconomic fears, but also because if Treasury rates are going to go up, why do you want to own risky assets? But by and large, the stock market's view on private credit is more of a top-down fundamental view of the macroeconomic climate, and therefore risks in being in risky assets and risky debt assets under either reflating conditions, which would be positive, which is why you see Blue Owl's stock price, the BDC price, go up in, say, 2020 and 2021, but go down really since the middle of 2024, May 2024, because May 2024, April, May, June, that period, we saw the arrival of beverage curve in the U.S. labor market and what that means, not just for consumers and consumer loans, but if businesses, especially businesses in this middle market, which is what's really served by the private credit boom, if businesses in the middle market, smaller, medium-sized businesses, are struggling to the point that they've stopped hiring workers, they're cutting back hours, they're even laying off some of their employees, they're not going to be in position, they're increasingly not going to be in position to pay back on these loans, which is why there's so much anxiety. And so accelerated sell-off in this space, or even parts of the space, like we see with Blue Owl, tells you that even the stock market is getting nervous about private credit, which is big red flag, big warning sign going on there. So, some of these prices are getting down to where they were at the 2022 lows and closing in on even the 2020 pandemic lows and lockdowns there back in March of 2020. This is Blue Owl, the management company, not just the one BDC, but the company itself and all the various funds that it operates. You can see since January 2025, which is really when the economy started to show more concrete signs of downturn, it's been downturn in the stock for Blue Owl. April, the liquidations, the merger proposal. Now here we are as of today, another huge sell-off. It looked like earlier in the morning, before the market actually opened, early morning trading, it seemed like Blue Owl was going to make a comeback. On the rest of the BDCs, we're gonna experience some bargain hunting, but it didn't last. As soon as the market opened, it just everything plunged back over again. And you can see the numbers there, the trend in the stock price. More recently, just since was that January 22nd, I believe. So just a couple of weeks, almost a 30% decline in Blue Owl. Going back to mid-July, which is a date that I said, on Monday, keep coming back to. The decline is now almost 50%. And really important thing about July is that's really when the macroeconomic, they said the economy was getting more uncertain, and I think I ended almost every YouTube video since then saying, no, it's the opposite. The economy is getting more certain, not more uncertain. And here, another angle on that, where even the stock market is selling private credit providers for that reason, because the economy wasn't becoming more uncertain, it was becoming more certain. It's just that it was becoming more certain about was not what everybody hoped it was or everybody thought it was going to be. There's supposed to be a second half rebound, or at the very least a 2026 rebound. Instead, as Steve and I talked about this weekend with leveraged loans, you see it there too. The sell-off is accelerating. The anxiety is accelerating. The negative perceptions about the risky marketplace, the risky parts of the marketplace right now. You can overlay leveraged loans here. You see it's the same exact thing. So it's not one asset class or another. This is a pretty widespread rejection of, first of all, the macroeconomic idea of rebound, strong economy 2026, more flat beverage curve instead, and all the implications to that economy. Accelerating downturn in the labor market, what that means as far as credit risks and maybe even liquidity risk beyond. So it's not just one thing or another here, it's confirmation all across the sector. And I keep going back to these comments. I mean, Blue Owl, the reason why we've been focusing on Blue Owl is because they've been at the forefront of this private credit story from the very beginning. All the way back when Jamie Dimon said cockroaches, it was Blue Owl's management that said, hey, look in your own portfolio. We don't see any cockroaches. And further than that, they keep protesting. This is the biggest part, the biggest problem. I've said this before, going back to the cockroaches and even the Blue Owl merger back in November, the failed merger back in November. Just open the books. If you're that confident that you've got nothing to hide or nothing wrong in your portfolio, show people. Tell us what you got in there. So the management of Blue Owl says, we don't see, the stock price back then, we're talking about in October, the stock price suggested that stock investors were looking at Blue Owl and saying, you've got a massive number of defaults sitting in your portfolios, maybe not today, but at some point in the near future. And of course, Blue Owl's management said, we don't see nothing. We've got nothing. Jay Powell says the economy is doing relatively, well. Yeah, it's losing tens of thousands of jobs per month, but that's no big deal, right? So everything is just fine. Our performance is well within tolerances. Fundamentally, we think the portfolios are strong. And the more they keep saying it, the more the market keeps rejecting it because it just doesn't fit with reality. The further we go along, like I said, the more certain the economy gets, the more certain investors are about private credit being in a bubble and therefore going to have to pay for the consequences of all those many years of bubble behavior. So the more that the private credit providers themselves try to reassure everyone, the more that it rings hollow and the more it actually contributes to the anxiety and even the selling that's taking place. And I think one of the more important things about this too, the accelerated downturn in these prices is also the parallel that we don't actually get a chance to see, except for these intermittent windows. Whenever a Bloomberg article comes out that talks about this fund or that fund is this fund is going to report losses, that fund is experiencing redemptions and withdrawals. The more we see selling in the stock market of these BDCs, the more likely it is that hedge fund investors and other investors too are withdrawing their money. Remember what I said about stage one of a credit crisis? Stage one of the credit crisis is really about where money flows out of whatever the bubble was beforehand. So as the bubble is building, money basically only flows in one direction. That's into the bubble. Then things start to turn around, and stage one is where money starts to flow out. So as we see the stocks of these various BDCs and anything related to private credit just get pummeled and crushed, especially the KKR one. You look at KKR. As they continue to get crushed, that suggests that not just stock investors are selling, but also funders and hedge fund investors and institutional investors in these funds are probably asking for their money back and probably demanding their money back at the same time, which raises the risk of getting into stage two, which is when right now all these funds have lots of I don't say lots of, they have alternative means to maintain their portfolios. They have, liquidity backstops and credit funds or credit lines that they can access from the banking sector. But eventually the banks might get the same picture and same idea that these stock investors and hedge funds investors get, and they stop, they say, that's enough. We're not going to keep funding your activities because we don't want to get further involved in it either. We aren't to that point yet. But the more we see these sell-offs, the more we see these sell-offs accelerate in disorderly fashion like we're getting today, the more likely that's going to be the case. So the temperature in the room where it comes to private credit continues to get raised more and more and more. As I said, the economy and all the consequences that go along with a poor economy continue to get more certain, not less, to the point that even the stock market is saying, I want nothing to do with private credit, which is, again, it's a red flag and alarm bell that should be going off in everybody's mind. So that's the private credit BDC story. I went over some more of the details in a video a couple of days ago. So if you want more actual details about specifically private credit, highly recommend you check that out. So now let's move on to risky financials, what I'm calling risky financials, before we get into the other ones. So this is Bitcoin here. Let's go backwards a little bit so we can see the price. Yeah, so Bitcoin's price down a huge amount, 25% in just a couple of days here. It's getting killed again today. And the reason is, first of all, Bitcoin is not a competitor to the US dollar. It's not a currency, and in my opinion, it's never going to be one. But that doesn't mean it isn't an asset with some inherent value to it. It's just not going to be a useful currency for reasons we don't need to get into here, but I've talked about that before. Instead, Bitcoin is a risky asset, is a risky form of store value. Therefore, it's incredibly volatile, and it trades a lot like a NASDAQ stock, a high beta NASDAQ stock. And as a result, it's not doing what a lot of Bitcoin, especially hardcore Bitcoiners, want it to do, which is to replace the US dollar, which, by the way, it's not going to do it. It's not, the US dollar is not being replaced. The dollar is not being debased. All these stories that are flowing around that were trying to explain why Bitcoin's price was going up, just don't, there's no corroborating evidence that any of it is actually taking place. The dollar is not being replaced, even though it needs to be replaced, and Bitcoin's not going to be the one that does it. So as a risky store of value, a lot like on that NASDAQ stock, it is susceptible to shifts in perceptions about risks. And so those perceptions about risks have shifted since the middle of July. Yes, Bitcoin hit could have hit a record high in October, but by and large, things started to change in the middle of July, just like they did in the risky parts of the private credit markets and in leverage loans and other parts of risky assets as well, risky markets as well. So you've seen a shift in at the margins of risk aversion versus acceptance of risk, and it's being priced. It's being priced most heavily right now into cryptocurrencies, Bitcoin being the preeminent one, the one that people pay most attention to, which has, of course, provoked comments and reactions from people within Bitcoin and in the space there. And then Saylor's comments earlier today. If you're not familiar, Michael Saylor is the chief for strategy. It used to be called MicroStrategy, now called Strategy, which was the first real Bitcoin treasury company. Now there's a bunch of them. Which leads to other problems, and maybe these other treasury companies are the ones who are being forced into selling here, because you see a downturn like that where it's straight down in just a couple of days. That's another telltale sign of liquidation. So people in the leverage holders in the space, like treasury companies, are likely being forced to liquidate the lower Bitcoin's price goes. And of course, Saylor is just doing his regular shtick here, which is every time Bitcoin goes down in price, he says it's going to go to 10 million. You're crazy not to sell it. When rational people would ask, well, why would I ever buy it at 125,000 if it's going to be volatile? I can just wait till it gets to 20,000 again, and I'll buy it back there. And what Saylor's point is, it won't matter if you buy it at 10,000 or 100,000. When it gets to 10 million, you're making a ton of money anyway. So basically, he's just trying to craft a narrative where you just buy, regardless of what the price is. And if, as he said earlier today, if you knew what I knew, Bitcoin would be $10 million tomorrow, which is about as meaningless of a statement as you could possibly. If everybody knew what I knew, I'd be worth 100 trillion tomorrow. It's a worthless statement that actually creates more harm than good, because now it's as Bitcoin's price is going down. Yes, we expect Saylor and all these Bitcoin treasury companies to double down on their excuses and justifications for what they're doing, but to this extent, especially using the language it does, talking about volatility as a gift to the faithful. I mean, it's more religious undertones that don't help. This is not a rational type of way of looking at what's supposed to be happening with Bitcoin. Again, Bitcoin already takes on the proportions of a religion to begin with, even to the point that it comes off as very cultish. And by the way, I'm not a Bitcoin hater. If I see Bitcoin going down to say 20,000 or something, I'm going to load up on the thing. I believe that the Bitcoin's price is going to go up over the long run. Understanding it's going to be incredibly volatile along the way. So I'm a trader in Bitcoin, which was exactly what Michael Saylor is saying. Is I don't want you traders. I want people who are going to hold on for the long run. Well, that's great, but in the meantime, as a risky asset, it's going to be incredibly volatile, which is exactly what we're seeing. And in what really interests me most, not necessarily about the Bitcoin price right now, but the direction it's taking and the intensity it's taking in the context of the wider discussion of the riskier parts of the overall marketplace. So it goes along with what we're seeing in private credit, as well as some of the other stuff that we'll get into. But it's a barometer or a proxy for the appetite to take on additional risk in these financial instruments, in these financial corners, which is why I called it number 2, financial risk. It's like I said, it's a proxy, it's a gauge of that appetite to take on a little bit of additional risk, or in this case, to take a little bit of risk off the table. And if you're taking a little bit of risk off the table, regardless of what Michael Saylor says, like I said, he's not doing anybody any favors here. In fact, he comes across the exact wrong way that you would want to. Rather than being reassuring, he leans further into all the negative stereotypes and perceptions that people have of Bitcoiners to begin with, not helping at all. But for our purposes here, Bitcoin is a gauge of risk at the forefront of risky perceptions. It is at the very forefront. So you see, for example, I always get into this too. Yeah, I mean, I'll skip this for a second. I'll come back to this in just a minute here. But you see, for example, the correlation with the NASDAQ. It's not really a strong one at the moment, because right now some of the mainstream financial risky markets, the S&P 500 certainly, but in the NASDAQ, not behaving as strongly negative as Bitcoin is. But you can see that there's a correlation. The NASDAQ stopped going up end of October. Bitcoin already turned around at that point. And the NASDAQ's kind of gone sideways as the marketplace overall has tried to digest what's going on in AI. And in many ways, Bitcoin is related to AI in a couple of different facets. So as that marginal proxy for risk behavior and risk perceptions and the willingness to take on additional risk or take away additional risk. I think it is telling us something about the very margins, the very forefront of these financial markets. Let's go back to this for a second here because there's a couple things in it. First of all, Bitcoin strategy it's got to the point. I think one of the reasons why there's short run selling in Bitcoin is that, everybody knows this, that with the Bitcoin price, it was 66,000 before I started recording here. It's below the average price, even as Michael Saylor said in a tweet a couple of days ago. It's below the average price of Bitcoin's holding. So there's a lot. It's emblematic of fears in the marketplace that some of these treasury companies, not necessarily strategy. I don't think strategy is at the place where it's going to have to sell, but a lot of the other copycats, and this is something I talked about yesterday with Pat and Tom and Brandon on PDB's podcast. A lot of the copycat treasury companies may be forced to sell. Maybe they might be the ones who are actually selling at this moment. Haven't really looked that deeply into it. But one of the things that's really important here, again, that goes along with Bitcoin as a proxy for risk-taking behavior, just look at the MNAV, which is the market value to net asset value. So the market value of the underlying holdings in strategy. So basically the market value of the stock as valued by the stock market compared to the market value, the net asset value of the holdings of the company. And for a long time, Strategy's MNAV was hugely positive, which meant that the market really believed what Michael Saylor was selling and therefore believed that, the value of Strategy was far and away greater than just the tokens that it held in its portfolio, just the Bitcoins that had acquired along the way. That the ability of the company to execute on that strategy, to bring in leverage and to wisely use the leverage to lever up the returns into the future. The market was saying, we believe it, we love it, we think that this is going to be huge. And so the MNAV not that long ago was 1.4, which meant that the market was willing to pay a 40% premium to own Strategy stock over and above just what they could buy from Bitcoin. Again, a vote of confidence in Michael Saylor and Bitcoin and Strategy's strategy. But over the last couple of weeks, we've seen the MNAV decline almost to, it's not quite there to 1, but as of this morning or as of this afternoon, it's 1.08, which is the market saying, maybe I'm not as confident over Saylor's strategy for Strategy as I was a little while ago. It's not really, to me, again, it's not really about forcing Strategy to sell Bitcoin. It's about perceptions about whether or not Strategy can execute its strategy and therefore how that fits into the overall dynamic of the marketplace. So the MNAV is another one of those doubts and measurable doubts that is creeping into the marketplace that suggests there has been a very big, profound shift in risk-taking behavior that is filtering its way into a variety of asset classes, which is why we talked about the multi-asset meltdown at the beginning of this presentation here, beginning of our video. So with the MNAV falling as much as it is, it's the marketplace expressing more doubts, not just about Bitcoin and Strategy and Michael Saylor, but about a whole bunch of things priced into something specific like this. And yes, there is a risk that maybe Strategy does have to sell Bitcoin, which would certainly be a huge thing, but I don't think it's necessarily, I think it's the other treasury companies that you really have to worry about at this point. But while the company does have $2.2 billion in US dollar cash reserves to pay out on all of its dividends and supposedly principal repayment obligations, that could go quickly too. And the lower Strategy stock price goes, which is essentially the collateral for everything, the more trouble the company might run into in being able to maintain its leverage. So maybe that increases the chances of Strategy selling down the road. But again, for my purposes, what I'm really interested here is Bitcoin as a whole and Strategy as it fits into the Bitcoin story about what the market is thinking overall in terms of risk-taking and whatnot. And then you get into all the reasons why, which you just went over. So yeah, but Bitcoin down 25% in a relatively short period of time. So moving on from that, we've got risky financials. That was that. Metals. Let's talk about metals. There's a lot of hope that there was going to be, at the very least, the bottom after Friday's historic sell-off, especially in silver. There's a bit of a short-run bounce in silver, and a lot of people, okay, here we come. Is this bargain hunters that are finally filtering back into the marketplace? while others are wondering, is this just a dead cat bounce? So silver had a pretty strong performance on Monday, not so much yesterday, and then today, another big sell-off that's taking place in the silver market. I talked about on Monday, on Monday's video, talked about some irregularities happening in China. That fits into the type of bubble behavior that we saw in silver. Look, let's face it. Silver was soaring for non-economic reasons, which made that rally incredibly fragile. It was not, I know it's difficult for especially a lot of silver people to hear because, we hear a lot of commentary from the gold precious metal space saying, oh, silver's on its way to $200 an ounce. It's on its way to $500 an ounce. Gold is going to 50,000. And maybe it does, but you don't want it to go there all at once. Maybe silver does get to $500 an ounce, but it shouldn't happen in a matter of just a couple of weeks. That's not the sign of a healthy market. This is a sign of an unhealthy market, at the least in the short run. By the way, again, just like Bitcoin, I'm not a silver hater. I actually own silver coins. I've got silver coins here. I've got silver coins. I actually have some of this stuff because I think this stuff is cool. Like the gold. This was actually a sponsor of mine of a YouTube video that paid me in gold and silver. And I thought that was amazing. So look, what I'm saying is you got to keep your emotions out of it and start thinking about these things rationally. And by every account and every metric that you could look at, silver had way, way overextended its upside in its rally, and for very obvious reasons too. The reasons were because supply was hard to acquire. That is not, by the way, a factor that's going to lead to long-run success in silver. A supply shortage is going to inevitably lead to the opposite. The supply squeezes always end in the same fashion because eventually the price goes up enough that it leads to de-hoarding of supply in all these various ways. In terms of silver, it could be people who are selling their jewelry, so it could be melted down and showing up various places. But also it's tariffs that have scrambled the global logistical chain for various metals. Copper is another one, which I'll get to in just a second. But inevitably, supply starts to show up. And when you get the speculation that comes into the run-up, the momentum players, it is a recipe for short-term pain, which is what we're really starting to see emerge from the silver market. And this should have been expected the entire way. Like I said, straight up is not a sign of stability. Straight up is a sign of fragility. It's a sign of desperation that once the emotion and momentum get expunged from it, leads to the downside case. So, silver has a fundamental upside to it, but the short run is likely to be, again, leave your emotions at the door here. In just rational analysis, silver is likely to undergo some really painful short-run circumstances. Like I said, the some fundamental measures for silver showed way, way overdone, way, way overdone. The gold to silver ratio is one way relative to, measuring silver relative to gold showed that silver's rise was well overextended compared to gold. And gold wasn't exactly sitting still doing nothing. Gold was rising pretty sharply too, just silver was just going way, way far past it, to the point the gold to silver ratio got down around 45, 46, which is the lowest we've seen since, 2011, which, by the way, was the last time that silver behaved in a similar fashion for slightly different reasons. But back in 2011, what happened? We heard all the same stuff that we've heard the last couple months. Silver was going to go to $100 per ounce, and then it was going to go to 200 and 1,000, and gold was going to, all that stuff. And instead, silver sort of it went parabolic and almost straight up, and then eventually supply showed up, enthusiasm, momentum waned, and it went back down again. So like I said, you got to keep the emotion out of it. The numbers, the measures, the metrics all said that silver was way overextended to the point that, 46 gold to silver ratio. And by another fundamental measure, just line up the gold to silver ratio inverted compared to Chinese GDP. Because let's face it, the Chinese economy as the marginal source of economic growth throughout the system, especially for industrial uses, it is a relatively good proxy for non-precious metal, non-safe haven demand for things like copper as well as silver, which is why you see a really pretty good relationship between the gold to silver ratio and Chinese GDP. When Chinese GDP is healthy and rising, then silver is rising more than gold because there's demand for silver in industrial uses. Throughout the 2010s, it was the opposite. You had gold that was performing better than silver. It wasn't always rising. It was toward the end there, the latter half of the 2010s. Gold was going up on safe haven as China slowed down even more, which is why the gold to silver ratio got up around 80 and kind of stayed there ever since the latter half of the 2010s. So since the Chinese economy is not accelerating, it's actually doing the opposite. From a fundamental perspective on the silver side in terms of industrial demand, it's another one that reinforces the notion that silver got way, way overextended on the upside. And fundamentally, there is a long way to go on the downside. To get the gold to silver ratio back up around 80 or even 90, right now you're going to see silver go below around 50 to less than 50, which is what I said earlier. And again, you can see the same thing happen in 2011 when silver soared well above not just gold, but also well above the Chinese economy 2011 heading into 2012 was already slowing down into the middle part of the silent depression, really the worst part of the silent depression, which was another warning sign that silver was way overextended on the upside. So even though there's a long run favorable fundamentals for silver as well as gold, right now it just got way too far, way too much of ahead of itself. Gold is performing much better relative to silver today, which is not surprising because, like I said, silver has been the object of so much of the speculation and momentum, and the severity of its supply problems far greater than anything we see in gold. So gold is kind of hanging in there, though it is getting caught up in the silver reversal to a certain extent. Though let's face it, too, Gold was going too far, too fast as well, so it was due for a correction. In fact, it's way overdue for a correction because you go back to August and gold has been going up pretty sharply. So wouldn't be surprised if we get a correction in gold. And by the way, the couple of corrections that we've seen recently, including the middle part of last year, gold doesn't necessarily have to go down or even crash. It can just go sideways for months at a time, which is it counts for a correction in the gold market. So the fact that gold is holding up better than silver is an acknowledgement of everything else that we're talking about. These safe haven fundamental properties that are in gold that were missing in silver, at least got overpriced in silver as silver went way far ahead of gold and way far ahead of industrial and real economy fundamentals. But still, would not be surprised if we still get a lot of volatility in gold. Copper is another one that has come up quite a bit. For a lot of the same reasons. Copper has seen several supply squeezes just in the past couple of years, including the last couple of them last year, related to the fact that fears over U.S. tariffs of copper supply have led to a major movement of copper sources into the United States. And as more copper ends up in the U.S., trying to get ahead of any tariffs, it's unavailable for the rest of the world to be able to use because it's locked away in the United States when most of the copper gets used outside of the U.S., especially in places like China. So there was a little bit of panic buying at the end of last year, especially from Chinese sources. And then there was also the same thing like we saw in silver, speculative momentum that really pushed the price up. But over the last month or so, and this is the warning for silver investors, despite the fact that copper supply is increasingly difficult to get, certainly out of the ground, the Indonesian mine that is offline, problems in South America. So long-run copper supply is really difficult. Yet because copper prices have gone so far, gone ahead so far, copper stockpiles are actually starting to show up in major copper hubs like London and Shanghai, which means copper is there's more likely to be weakness in copper ahead, just like there is in silver, because eventually the supply matter does get resolved in the short run, even though long-run supplies are more difficult. And that leads to volatility in the short run prices of these metals, like we've seen in copper the 3 times that we've had squeezes up until the end of last year. So there's a lesson there for silver as well as precious metals overall. Copper supplies are starting to show up. And one of the reasons they are starting to show up is because, as I just told you, industrial demand is not strong. A lot of people were saying that industrial demand was strong, and that was one of the reasons why silver and copper were soaring ahead as they were. And it wasn't just supply reasons. It was actually the electrification through EVs and everything, or the AI build-out boom is going to require a lot of copper and a lot of silver. And maybe that's true, but in terms of the overall market structure, that's kind of a drop in the bucket. And what we're seeing is that the actual fundamental real economy industrial demand for these metals is not strong and is actually tailing off and getting weaker. So the only thing really supporting things like silver and copper were the inability to immediately source supply, which is in the process of being alleviated as well. So fundamentally, copper is not priced around $6 per pound at the CME, the same way silver is not priced at 120 or whatever it was at its high, nor maybe in the 70s where it is today. So fundamentally, the measures all say, like I said, keep emotion out of this rationally. Silver, copper, and maybe even gold to a lesser extent just got way overextended on the upside. So the copper to gold ratio, that's another one. I bring this up because the copper to gold ratio continues to be closer to the record low rather than something like a reflationary number, let alone inflationary number. So the copper to gold ratio is definitive measure that says the reason that gold was going up and therefore silver as an extension of precious metals had nothing to do with dollar debasement or inflation. There is no sign of inflation anywhere. And when you see what's going on in the labor market, that just reinforces the message. Gold was going up not because of inflation, but because of fears of everything that we just talked about in this specific video, including the private credit and credit markets as a whole. It's fears that, in China, for example, I talked about this with Mike Green as well as with the Brent Johnson too. That was a great conversation. The reason why people are buying gold in China has nothing to do with the dollar or inflation. It's the opposite. People in China see what's happening in the Chinese economy, in the Chinese financial system, in Chinese banking and real estate. Where are you going to put your money? You've got tons of US dollars that are flowing into China because of the trade surplus. What are they going to do with all those dollars? They're not going to buy Chinese assets. Maybe you buy some AI stocks, but that's a risky bet too. So the Chinese, what proceeds are making their way into the onshore system in yuan. Chinese are buying government bonds by the boatload. You should see the short run interest rates in Chinese government bonds. So safe haven demand makes sense from a fundamental perspective from China. It has nothing to do with inflation nor the US dollar. It's everything to do with the global macroeconomic climate, as well as some big picture stuff that Mike Green and I talked about, the lack of faith and trust in the longer term future that is eroding because people feel something's not right here. And they're right to feel that because something is not right here. But the point is, gold was not rising because of inflation and dollar debasement. So it's a deflationary signal, a safe haven, which is one reason why gold is performing relatively better than silver. And gold and copper to gold ratio at a record low is an unmistakable sign of what the market is actually thinking in what's happening in that marketplace. We could go on with other metals too. I didn't add them because this is going to be a long enough video as it is. Iron, another fundamental metal commodity. Iron prices are sinking as well. They never really got that high to begin with because there's no supply interruption in iron. So iron is an important one where you take away the supply factor from the price and you see basically nothing. And then more recently, iron has become weaker, which is a measure of demand that's falling off in real economy in industrial terms. So we talked about that. Let's go to now what we got: safety. So safety, we're going to talk about the Treasury curve. We could go into other asset classes, but it's just the Treasury curve here. Long end of the yield curve has had somewhat of an upward bias for the last couple months, which, people have interpreted in a lot of different ways. But as you can see, just from this chart here, the upward bias in the 10-year Treasury is nothing like we've seen in episodes past, whether it be, for example, the first phase after the global bond rally started in 2020, late 2023 and early 2024. The 10-year Treasury hit its bottom in December of 2023. What was that around? It was 4% or a little bit less. And then it backed up like 50, 60 basis points from there. Same thing in not last year. I keep thinking it's 2025. Same thing back in 2024. The 10-year Treasury got down below 4% just as the Fed was starting to cut rates, which was the trigger for the market to start uninverting the yield curve and steepening it out, which led to a pretty substantial backlash. I think it was something like 80, 90 basis points in the 10-year Treasury. So the fact that the 10-year Treasury is in a short-run fluctuation where the rate is rising, it's not all that much of a fluctuation. We're talking about 20 basis points. It's not even close to what we've seen in the recent episodes and recent past periods. Plus, it's easily explained by the ongoing steepening and uninversion process, which you can see in some of these other charts. In fact, what should stand out to you from the Treasury market, especially as we go through everything else, as we went through everything else in these other markets, is how remarkably stable interest rates have been, especially in the short run. Even over the 10-year Treasury, and even the 30-year long bond rates have risen a little bit. Like I said, they haven't risen all that much. And more recently, they've been within a relatively narrow range. While the 2-year Treasury, for example, the 2-year yield, that spot on the curve, has been remarkably stable for 5 months running, as all this other stuff has taken place, including the arrival of Jeff Schmidt, the president of the Kansas City Fed, who dissented against rate cuts and therefore represents the hawkish faction of the Federal Reserve, which the market doesn't really necessarily care about the Fed all that much, but it is a factor to consider. But it's the overall the remarkable stability in interest rates, given everything that's been thrown at the marketplace from the narratives I talked about before. That 2026 is going to be a legitimate economic boom. It's going to be a rebound. The rate cuts from the Fed were going to unleash, maybe more inflation. The final arrival of tariff inflation, that was going to happen. People said that's taking place. What's the other name? Oh, the Reserve Bank of Australia, that they actually turned around and hiked rates for the first central bank to hike rates. Supposedly now that's going to unleash a global wave of rate hiking. The market is saying, nope, don't see that happening either. So instead, you continue to get bull steepening on the yield curve, continued interest in safe haven demand for all the deflationary reasons, or all the reasons that we're supporting gold, for example, on its way up, and they continue to support gold right now. It's just the curve steepening. That's what we're seeing. That's why longer-term rates tend to look like they have an upward bias, even though the Federal Reserve is cutting rates. And this is no different than what we see in every single cycle. So when the Fed started cutting rates in 2024, that was the signal to the marketplace. It's time to uninvert this curve and start steepening out. But as the Fed has gone slowly with the rate cuts, which has held up the front end of the yield curve, as you can see in the 2-year Treasury, that means that the steepening has to take place with less immediate downside in the front end rates, which is why one of the key reasons why for a long time there last year, the yield curve sagged so much at that 2 to 3 year spot on the Treasury curve. It was trying to steepen out but also maintaining expectations that the short-term interest rates are going to go a lot lower. And as I talked about in a recent video, you just look at where the curve is today, and where this steepening process, as it unfolds, where it is likely to end up, or where it should end up, at least in historical context. When all is said and done, the difference between the 2-year and 10-year historically has gotten up to 200 and maybe even 300 basis points and above. So the fact that the 10-year Treasury is not moving all that much higher, despite all of that pent-up steepening demand in the marketplace, the fact that the 10-year isn't moving suggests that the market is still pricing in the front end eventually going to go down to get to that 200 to 300 basis point steepening in the yield curve. And it's even though you can make arguments that more likely 200 than 300, even if it's 200, it doesn't. I mean, if the 10-year is sitting around 4.2%, and you think the 3-month rate, for example, which is the broadest spread, should be 200 basis points below that, you're talking about the 3-month rate are down around 2.25%, which would put the federal funds target somewhere around 2 to 2.25. That's a significant move lower in short-term interest rates, is what the curve is really trying to tell you, even if people miss the signals because it looks like the long end has an upward bias. Because it does have an upward bias, it's just not for the reasons everybody says. It's actually the contrary, the exact opposite of the mainstream narratives. And it is consistent with everything that we just talked about in this video: safe haven demand, anxiety over private credit, volatility in something like silver, and therefore spilling over to precious metals, therefore demand for safe haven over and above something like gold if it's going to be volatile in the short run. And by the way, there is no data and evidence that suggests the world is moving away from U.S. Treasuries. Central banks may be moving away from U.S. Treasuries in terms of their portfolio holdings, but that's another one the market says don't care. Don't care about what central banks do. It only matters what the system does. And all the evidence says the system not only continues to use U.S. Treasuries, it also continues to use U.S. dollars in the same ways it has before. Look at the proportion of U.S. dollar denomination in something like FX forwards, which is the key point here. If there was any move away from the U.S. dollar, you would see it in FX forwards and FX swaps, and it doesn't show up there. So the yield curve is still steepening, and that accounts for what people perceive of as an upward bias in interest rates, but the long-term interest rates. But the upward bias in long-term interest rates isn't even all that much of one, even in comparison to more recent episodes where we've seen rates go up and down in short run fashion. Like I said, early 2024 or late 2024. Tips, I mentioned this recently too, but this is another one that shows the market perceives zero inflation risk. In fact, what it says is that, okay, oil prices are going up here in the short run, which is one reason why short-term tips break evens are rising, because oil is one of the biggest inputs that goes into the CPI. And of course, the CPI is what the government uses to pay inflation protection to those who own tips. But you don't see it in the longer term break evens. In fact, you do not see it at all in the 5-year forward rate, which is the longest run. It's supposed to be a measure of the really long-term inflation expectation, consumer price expectations. So what the market is saying is, no matter what happens in the short run, maybe prices do go up because of, Pepsi was raising the prices of its sodas and snacks beforehand, or oil prices are rising because of non-economic factors like geopolitics. The market is saying, even if there's price rises and price impacts in the short run, they're not going to last to the long run. There's no inflation risk. And instead, what the market is really saying, especially when you combine these tips rates and tips real yields with nominal treasuries that we just went through, the bull steepening on the curve there, what the market is really saying is that any price increases that do happen in the economy are more likely to add to the negative deflationary pressures in the real economy moving forward. So it's another reason why safe haven demand is rising. It's another reason why the marketplace is not seeing dollar debasement or move away from the dollar or anything else. The market is saying that this is an unhealthy economic climate. In an unhealthy economic climate that is becoming more certain that it's unhealthy and getting unhealthier all the time, the more you're going to see the risky parts of the market like private credit, stocks, leveraged loans, Bitcoin, cryptocurrencies sell off because of the anxiety and really the just looking ahead. If this continues to get more certain across the macroeconomy, especially in the United States labor market, the more problems there are going to be and the bigger problems there are going to be in those risky parts of the market. So zero inflation, lots of safe haven demand in the Treasury market. Like I said, the 5-year forward rate it's much closer to the latter half of the 2010s than something that would represent a meaningful acceleration in actual inflation. The market is saying it's just not there. So just from that alone, you have to reinterpret what happened in gold. If you're just focusing on gold, you say, well, and everybody tells you the gold prices go up because the dollar is going to go to zero, or dollar's going to be doomed. The world is rejecting the dollar. If you only focus on gold, it seems like that's validating that thesis. But if nothing else is pricing the same idea, you got to go back and think, what else could possibly explain why gold is going up? And the copper to gold ratio gives you that answer, as well as everything else that we're going over here. Last thing we're going to get to, why all of this is taking place. And that is the labor market data that we got today. I'm going to go over this in more detail in videos that are coming up. But essentially, see if I have the slides here ready for me. We can do it right now. But we got a whole bunch of labor market data. Yes, the JOLTS data was released and it came out today, and it was not good. Let's see if I got them in here, because JOLTS hiring was weak, even though it bounced. Job openings tumbled again, which is what the mainstream really looks at, though. That's not really necessarily the one that, yeah. All right. So, like I said, JOLTS hiring rate bounced a little bit in the month of December. That's the update we just got today. Quits rate was a little bit higher compared to its low a couple months ago, but neither of those in a good place and mostly fluctuations. The job openings number, and really the job openings rate, fell to its low. It fell below what it had been at the lows in 2020. So even job openings, which vastly overstate demand for labor, job openings are saying demand for labor is getting suspiciously incredibly weak. And then the other thing that came out today was Challenger Gray and Christmas in terms of job cuts, announced job cuts, and lack of announced hiring, which was, again, one of the weakest on record, weakest January. And as far as job cuts, those soared above 100,000, which was the most in any January since January of 2009. And as Challenger Gray and Christmas put it in their report and in their press release, what it shows is that contrary to all those expectations, employers themselves must not be optimistic about what's taking place here in 2026. So you put that together, what we just went through in business development companies, private credit, and Bitcoin as a proxy for marginal risk taking. What it says is that the macroeconomic climate continues to get more certain, and that certainty is more about deterioration. The less you're going to want to be exposed to really risky assets that either had performed well last year for momentum reasons or other reasons other than solid economics, like silver. You don't want to be exposed to those things as the risks in the macroeconomy and the realizations that these are rising negative risks in the real economy continue to rise as we go into now February of 2026, contrary to the mainstream narrative that the economy is going to pick up because central banks had cut rates and we got past tariffs uncertainty, and then in interest rates. Central banks are going to follow the Reserve Bank of Australia. The Reserve Bank of Australia raised rates after cutting a couple times last year and the year before. That's going to herald the sea change in central bank behavior. They're all done with the Pringles can. The Pringles can is last year and the year before. That's not what we're getting from the marketplace. That's not what we're getting from these signals. That's one of the reasons why this multi-asset meltdown this week is an important development, an important signal all of its own. It fits with the actual macroeconomic evidence as well as the interpretation of what these markets say to us individually as well as together. You never want to focus on one market or another. It's what they all say, and when they're saying the same things at the same time, it really becomes a powerful and compelling signal. And that's what we're really getting here in the early stages of 2026. It is a powerful, compelling signal as the economy gets more certain, not more uncertain. And that certainty is the wrong kind of certainty from what most people are expecting. And when you have, it doesn't matter if it's financial assets or macroeconomy or even something outside of the context. When you have expectations that are this and reality comes in here, it leads to this type of volatility and violent backlash because people have to reprice and recalibrate at the very least, as well along with take into account why they're doing all that and what it really means moving forward. But the marketplace is becoming more and more skeptical about the upside and increasingly worried that there really is a downside in all of these places. And that's why we've got the volatility and really substantial market moves and all the stuff that we went over here. So that's where we're going to leave it here for today. Obviously, we're going to pay attention to all these markets moving forward. Even if we do get eventually some bargain hunting in things like silver, that wouldn't be a surprise. Some dip buying, even in the BDCs or Blue Owl and other private credit sources. Nothing ever goes in a straight line, but more recently we've seen some straight lines going down, which is why I wanted to bring this up on YouTube here today. So until next time,